Good morning, it's Daniel Pessar. Today we're speaking about trusts. Trusts are one of those things that could be not only a good planning tool, but could be a great investment. You could pay money to set up a trust and actually get more cash in your pocket. In fact, the return on investment can be very, very high. Let's think of three different examples, and each have lots and lots of rules, but we're just going to explain the opportunity at a high level. The first example has to do with income taxes. Imagine you make $500,000 a year from your law firm job or your medical practice, and you also make another $100,000 a year from your investment portfolio. Now, if you were to move your investment portfolio to a trust, again, subject to certain rules, the income, that $100,000 in income from those investments or from that portfolio will not show up on your own personal tax return. It's going to show up on the trust tax return. And if you, let's just say, were to qualify for certain deductions, like the SALT deduction, the state and local tax deduction, but only if you make up to $500,000, you might save tens of thousands of dollars in taxes just by virtue of moving those assets out of your name and into a trust. So imagine spending a certain amount of money to set up a trust and moving those assets to the trust. Those assets and the income still being used in a way or directed in a way that is consistent with your goals, and then saving tens of thousands of dollars in taxes just because you did that move. Example number two. Let's say there are certain government benefits. This comes up in the context of special needs trusts very commonly, which can only be accessed if you make under a certain amount of money, or a certain person makes under a certain amount of money. So what's done is structuring to take certain assets or certain income out of a person's ownership or put in a trust rather than putting it in that under this person's ownership, so that this person does not now become disqualified from certain government benefits, such as health related benefits. And then a third example might be other financial benefits that can be qualified for only if you have not exceeded a certain income threshold. Imagine certain scholarships and other benefits that will not accrue to someone who has a certain amount of assets or income. There's many other reasons that people use trusts. Obviously, estate planning. Sometimes it has to do with concerns that a child might squander certain funds. Maybe they'll invest in their friend's exciting new investment and that money goes away. Maybe the family is not so excited about who this child is marrying, and they're concerned that one day some of these funds will, that the couple will not continue to stay married, and some of the funds will end up going to that individual. Sometimes it has to do with marketing, that you have a child who maybe is an aspiring politician of some kind. They want to be mayor, they want to be a congressman, and it will serve them and their narrative to be more middle class in terms of their income and their assets, rather than gifting them a certain amount of assets or income that will make them seem like someone who's not so relatable to the voting base. Lots and lots of interesting opportunities with trusts, but those opportunities that come with a return on investment, a cash return on investment, you're going to spend a certain amount setting up the trusts, and then maybe within 12 months, you've already recovered way more of that amount in cash benefits. That tends to be an excellent investment.